Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and largely markets have not changed a whole lot from when we last left off, which is about 2 weeks ago. But things have changed a little bit in terms of how markets are currently trading, how their expectations have changed a little bit with respect to inflation. So let's take today and give you a brief overview of where we currently sit and how we expect markets to trade here over the next couple of weeks. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with a major market update in terms of where the major indices currently sit, as well as some seasonality, both 1 month and 3 month seasonality to put into the context of the broader picture here. Then we'll take a look at the sector rotation model and seeing where sectors are currently moving. We are seeing a fair amount of rotation here from the sectors, which is a particularly good sign for a potential move here to the upside for equities. We'll take a look at fixed income markets and how they've shifted a little bit with respect to inflationary concerns over the past couple of weeks, what that has changed for commodities, as well as the economics behind the inflationary concerns, or rather the easing of some of these inflationary concerns. And then we'll share with you our ideas here at the very end. But the primary question that I want to help investors answer from today's session is, has the recent market consolidation that we've seen largely over the past 3 months or so, does that set the markets up for another rally? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my economic research, and the ideas that I currently have and how I'm viewing the current markets based on that. So let's start off with monthly seasonality. This is going back, looking at monthly returns for the S&P 500 going back to 1928. And what we just came out from was May, which is a particularly dismal month for the S&P 500 historically. And we're going into June, which is historically, on average, a very average month. 57% of the time the markets are up. That is pretty much in line with market averages, and it's on average up about 77 basis points, which also is very much on average. So June is just a very average month, but it goes into July, which is the strongest month of the year, up 59% of the time and up 158 basis points out of the year. So July is one of the strongest months that we expect, and June is very much a very average month going into the year. So that just sets into context, broad picture, what we're currently expecting, which is a positive month, but not a particularly stellar month from the equity markets. And then when we look at 3 month seasonality returns, we are entering what is one of the strongest 3 months, the second strongest 3 month return in the S&P 500, which is from June to August. 64% of the time, the markets are up substantially higher than average, and it's up on average about 318 basis points. But again, going back to this chart, as you can see, most of that performance comes from July. June and August on the both sides are very average months from both a probability as well as from a return perspective. So just keep that into your mind as you're thinking about, we're entering into a strong month or strong quarter rather, but the front and back end of that quarter is relatively average. So that kind of hopefully sets up some expectations around where markets may potentially go. And then we have to really look at where we currently stand in the equity markets to decide whether, if that context that we just saw from seasonality applies to where we're currently sitting. And then if we look at the S&P 500, weekly chart, very strong weekly chart that we continue to see pretty much since for about a year or so now. And if you look at the daily chart here, strong uptrend, but started to slow down in terms of momentum. As you can see here, RSI started to slow down quite a bit here. And what we have has been this double top that has recently formed here over the past few weeks. Now, the markets are pushing back towards this double top and potentially breaking higher here. So that is the potential upside that we see here from the S&P 500. And the question is, what indicators can we look at that help us understand, is this a triple top that is going to fail and come back down, or is this a triple top that is going to break out? So let's take a look at some of the evidence from other sectors and other indicators that can help answer that question. So if we look at QQQ, the NASDAQ 100 index, let's look at other indices. That's always one place to look. The NASDAQ 100, similar double top that we have seen in the S&P 500, already has started to break out here to the upside. Now the QQQ, the NASDAQ 100, is not near its all-time highs yet, but it is starting to break out here, and that is fairly constructive back towards its all-time highs. And then if it breaks out above its all-time highs, that certainly puts the markets into a much more bullish state. If the S&P 500 breaks out higher and we see the NASDAQ 100 follow along. And then if we look at the Russell 2000, the IWM, after what has been a very strong move here to the upside after the election, this is a market that has been consolidating for far longer than the NASDAQ and the S&P. For almost 4 months here or so, it's been consolidating. And it is also near the top end of the range and potentially about to break out here as well. So this breakout, in my opinion, has a much larger potential because you had a much bigger, stronger move here to the upside, a much longer consolidation. Now, this doesn't necessarily mean it's going to break out now, but if it does break out, you have substantially much more upside. We could see the breakout here in July. That's yet to be seen, but certainly that's the question that we want to help answer. So sometimes we want to look at market breadth to help us give us some indication as to how are the internals of the market currently looking. So far, they look fairly strong. If you look at the RSP, the equal weight S&P 500 index, also near this effectively triple top. This is telling us that the strength of the market is not just coming from the top 10, 15, 20 stocks in the market, which does make up a significantly outweight of the broader markets. When you look at a market cap index like the S&P and the NASDAQ, where the top 10 names make up the lion's share of the index. But when you look at the equal weight index, where every single piece of the 500 names in the S&P 500 have the same weight, and that index is also trading near all-time highs, that shows us that there's strength across the entire market. That is a good indicator for a potential breakout. When we see the market cap indices making, pushing towards all-time highs, but the equal weight indices are failing to get near those levels, those are signs that we're near a market top. That is not what we're seeing here right now. So that's fairly strong. And then you look at the number of stocks that are trading above its 50-day moving average. This is also something we're continuing to see some improvements from. We're continuing to see some improvements from as it continues to have higher and higher percentage of stocks trading above its 50-day moving average. That's also constructive here. If you are looking to see a market break out to new all-time highs, you want to see more and more stocks participate in that rally, more and more stocks reclaim that 50-day moving average as a potential signal for that move here to the upside. So far, market breadth looking fairly positive here for a potential breakout. That in all of that doesn't necessarily mean we're going to break out, but the market internals and the market breadth certainly are fairly strong and supportive of a potential breakout here. Now, the question though is not necessarily from my perspective if we're going to break out. I'm fairly confident that we are going to see a breakout, but the question for me is more along the lines of how big of a breakout are we going to see? When you look at that seasonality chart, that doesn't instill a lot of confidence that we're going to see this massive breakout, especially after we've seen such a strong move from equity markets over the past year or so, especially when valuations are trading at fairly stretched valuations. This doesn't instill the confidence that markets can move another 20, 30% higher here towards the end of this year. This leads me to believe that we're going to see more muted returns here to the upside. So especially in that type of environment, you have to be extremely careful in picking stocks or picking sectors or subsectors that you're going to play this potential breakout in, because not all sectors will be the same. You might see some strong sectors that do fairly well, and then you see a lot of sectors that perhaps perform fairly poorly. And if you're simply just long the overall market, you may not get the performance that you want. So it's important to evaluate where is their performance, where is their potential within the equity markets for that breakout here. So one big factor that we want to pay attention to is value versus growth. And we continue to talk about this because it is still the trend that we've been talking about it for months is still in place. Value that has underperformed growth for many, many years has put in this bottoming formation during the pandemic. And so far, this bottoming formation is still holding. There were some investors that were concerned that growth was coming back to life back here in late March, early August, early April. But so far, those concerns are not true. We continue to see value outperform growth. It has stalled a little bit here, but we continue to see this potential breakout here. And right now, we are just at a potential verge where value could start outperforming growth here again. So far, everything that shows me from a technical perspective still instills confidence that value will continue to outperform growth. So as you're thinking about this breakout, and you're thinking, should I get back into those high beta tech names, those names that really performed very well towards the end of last year, pretty much all throughout last year? Or do I go back towards more value-based, more companies that are trading at slightly lower valuations, companies that are profitable, companies that are paying dividends, companies that are more stable, that are quality? You know, from my perspective, it's still clear to me that I would prefer to position my portfolio towards value-based names rather than high beta growth names. That doesn't mean that you can't pick specific names that you think have a strong thesis and have strong growth potential in this type of market environment, but you have to be far more selective with that. Versus last year, pretty much any type of high beta growth name you picked, you are going to be right on. Nowadays, you have to be far more careful with that. And then when you try to take a look at the sector rotation model, this is really where 2 weeks ago, I was showing you a sector rotation model that was starting to look fairly, I would say, what's the right word? It started to look fairly ugly, meaning we were seeing two names, technology and discretionary, moving towards this particular direction, moving in the leading category. And pretty much every other sector was moving towards weakening. We saw this across the board here a couple of weeks ago. Now, this has shifted a little bit here. Now, the sector rotation model right now is actually a little odd, but it's still moving in the right direction. You have technology that is moving into the leading category. You have discretionary moving towards the leading category, real estate, communications, even energy is coming back to life a little bit here. And then you have industrials moving sort of in the right direction, staples moving in the wrong direction, financials, and so you have a fairly mixed bag here of about 5 sectors moving towards leading and about 5 sectors moving towards lagging. So this rotation is getting back into more of a healthy market rotation model where we have about half the sectors moving better and half the sectors moving weaker. So this is further evidence that the current market rally that we're seeing is getting a little healthier, and that sector rotation underneath the hoods is looking fairly strong. And this also provides evidence to help us understand as we look for a potential breakout, as we look for opportunities here in this market, where do we want to focus that attention on within the sectors? So a few, I think, highlights that I want to point out here. Communications, similar to the S&P 500 forming that double top, is already starting to break out here ahead of the equity markets. So this is a sector that is leading the markets higher, that is outperforming the broader markets. That is typically where you want to look for some performance as you're looking for this potential breakout. Value-based names within communications is certainly one place that I would pay attention to. Another one that has seen incredible strength here is real estate, and this is one worth paying attention to, but I do want to warn investors here. We have seen some fairly sizable negative divergence starting to show up here. Higher highs in price, no longer confirming higher highs in momentum. That leads me to a higher probability of a pullback here. I do prefer in real estate to be a little bit more cautious and a little bit more patient, wait for a pullback before looking for opportunities, even though real estate is by far one of the strongest sectors here right now. And in an environment where interest rates are starting to come down a little bit, that's going to provide further support here for real estate. And there are some very strong thematic plays within real estate, but be very careful just of the timing at the very moment to step into real estate. And lastly, technology. Technology also showing a little bit of strength here. We were looking at what looked like a bit of a head and shoulders formation that was forming, but so far that seems to be invalidating it. One of the strongest, I would say, signals of a chart pattern actually is a head and shoulders pattern that is being invalidated. When you have an invalidated head and shoulders pattern, that is a strong move here to the upside. Just remember when we talk about technology, because I think some investors will think technology outperforming here means higher beta tech names is back in play. But remember, XLK is a market cap weighted index, which means the biggest weights are towards the big names like Apple, Microsoft, Alphabet, Facebook. These names are what I would consider more quality technology names rather than high beta tech names. These are profitable companies, highly profitable companies with high operating margins that are not growing as fast as some of the higher beta tech names, but that is where the performance is. So as you're looking for these types of tech names, focus on bigger, focus on quality, focus on stocks that perhaps are even paying dividends in the technology sector. Those are the ones that I think may have some performance here in technology. So shifting our focus a little bit towards interest rates, because this is largely what has been a driver of equity markets here over the past, let's just call it 3 or 4 months or so, because the big move here in interest rates has caused a pause in the rally. And then we had multiple, I would say, scares, if you will, of inflation, of whether inflation was going to be more transitory or more permanent. Multiple scares that inflationary concerns were going to be more permanent. But so far, what we've seen on average over the past 2 months or so, 2.5 months or so, is that inflationary concerns are continuing to ease. We're now near the bottom of the range, 155 basis points. My expectation is that you're not going to see much lower in terms of interest rates, but this certainly means that the fixed income markets have started to ease quite a bit in terms of their expectations for inflation. And that has in turn turned treasuries into at least a more stable asset. After a big fall here to the downside, we see treasuries trading sideways here. Is this a bottoming formation? We're going to start to see a rally here in treasury. That's yet to be seen. I think in the short run, you're more likely to see a range bound here. Range bound, at least for equity markets, means that it's going to instill a little bit more confidence. Not quite the strong rallies that perhaps some investors are looking for, but as long as fixed income remains stable, that provides some confidence for equity markets to move grinding, that continues to grind higher here to the upside. And then when we look at commodities, this is one that we still have to really pay attention to from an inflationary perspective, because commodities that go into the production of all consumer goods that we consume, whether we're talking about consumer discretionary to consumer staples, whether it's corn, wheat, and soybeans that we eat from a staples perspective, or things like cotton, iron ore, base metals. These are things that go into the consumer electronic products that we buy. These input prices have been growing at a much higher pace than many investors are expecting, and that's going to have some ramifications on consumer goods that we consume. So that's one area of inflation that we are still fairly concerned about here at the very moment. So it's very important to pay attention to where commodity prices are trading, how they're continuing to accelerate here to the upside, and whether that's going to cause some more permanent inflationary concerns. That is one area that I'm still very concerned about. But if you look at gold here, strong move here, breaking out above this $166 level that we talked about here. The breakout came back to retest this as support, and a very strong move here to the upside since then. And we finally got a return back to the 21-day moving average here last week. It's bounced off of that level. That confirms for me that we're likely going to see a revisit of this 183, 184 level here to the upside for gold. And if we look at crude here, crude last week finally broke out here above the $66, $67 level here. It's broken out here, pulling back a little bit here today. And the question is whether crude is going going to continue to resume its move higher here. There certainly seems to be some, I would say, interest in the markets to think that crude could rally up higher here towards the 80, potentially even higher level here to the upside. So this is one to pay attention to for those of you that are energy traders or energy investors, because this could point to more upside here for XLE that has been one of the strongest sectors here in the S&P 500 this year. So when we look at the economics here, a big concern of inflationary concerns over the past couple of months has been around the job numbers, and has been around the number of people returning to the job markets. And we were seeing that not many people were returning back to the job markets, not at the pace that we were hoping that we were going to see. And that has caused a job shortage, and that has caused wage inflation across the board in many, many industries, not to mention that we already have a global supply chain that's extremely strained. And when you add a labor shortage to that, that has really exacerbated the inflationary concerns that we have seen. The good news is that we're starting to see some of that reverse. We're starting to see job numbers come out fairly strong here in May. ADP non-farm was 978,000 versus 650,000. That was expected. Unemployment claims over the past month continues to trend in the right direction, meaning people are returning back to work. Hopefully this is going to continue, and this is not just a 1 month number. And if it continues to move in this particular direction, that's going to ease some of the wage inflationary concerns, that hopefully ease some of the supply chain concerns that are starting to work its way out, but still, fairly strained here at the moment. But those are some of the things that are causing the interest rates to come down a little bit, causing markets to be a little less concerned about permanent inflation. But there are still, like I said, aspects of the market where inflationary concerns are still very real. When we break down where inflation is being caused from, there are still segments of the market, like I said, raw material goods, that continue to be a big problem here for consumer goods. Also, car manufacturers. We've been talking about chip shortages and the ramifications of that. Car manufacturers is one of the biggest sectors or subsectors that have been squeezed by this chip shortage. And that has caused used car prices to shoot up. That's part of why I was looking at advanced auto parts here on CNBC last week, is because one of the main beneficiaries of car prices shooting up is really used car repair and maintenance stocks. Because when cars are really expensive, guess what? You choose to use your used car for a little bit longer, and that's going to require repairs and maintenance. So stocks like advanced auto parts, those are the types of names that are going to take advantage of that. So as you look at this inflationary concern and look at some potential downside for some names, that also provides some potential upside for other names. So this is really where you have to be tactical in this current market, and making sure that you understand what's moving and what's moving it, to better understand how you can position here in this particular market. So as we look for some opportunities here, our daily play here for today is Norwegian Cruise Lines. And we're looking at Norwegian Cruise Lines because price action here looks fairly constructive, and we're looking for this potential breakout here. We had this triple top here around 32. It broke out here above this level, came back to retest this as support, and started to bounce higher here. So this is the potential upside that we see for Norwegian Cruise Lines. And the long-term, target that we're looking for here is this $40 low that we saw prior to the pandemic. So we're looking for a potential upside here to $40. And the reason that we use a debit spread is because it is trading near this particular channel here. There is also the potential of it returning back to this $30 level here or so before it reaches that $40. So we're taking a limited amount of risk here to the downside by using a debit spread and trying to reduce our exposure as much as possible. So that's why we're looking at Norwegian Cruise Lines here at the moment for our daily play. Alongside our gold view is some of the mining stocks. Newmont Mining breaking out recently above the $68, $70 level here to the upside. Big move to the upside, and we've seen a consolidation back to the 21-day moving average. The stock has held that 21-day moving average, and that is the opportunity that I see for Newmont Mining to resume at least a move back up to its 52-week high, if not potentially higher here to the upside, taking advantage of further upside here in gold through a gold miner like Newmont Mining, which is one of the strongest gold mining stocks. And lastly, United Health. What I really like about United Health is that, one, it's one of the strongest healthcare companies that we have here in the broader markets. And we've seen an incredible amount of strength here from this type of stock during the pause, if you will, from equities as interest rates rallied. So pretty much since the beginning, mid-February, when tech stocks started to sell off, we saw healthcare really accelerate here to the upside. We saw an incredible amount of strength here. But recently, we've managed to pull back here from that strength below the 21-day moving average. We haven't seen a pullback here below the 21-day moving average, which is why I think now is the opportunity to look for some long exposure here in a name like United Healthcare and get it at a better risk-reward ratio than rather chasing it near all-time highs. And I felt, even though this is one of my top picks within healthcare, I always felt that I was chasing it over the past few months. Here, we finally have this opportunity of this pullback here, and I think now is the potential time to pull the trigger on this very strong name. So with that, that covers what I wanted to share with you here today. I hope that this helps you better understand how I'm viewing the markets. Like I said, things have shifted a little bit, not a whole lot, but seasonality certainly favors to the upside here. Market breadth, the market internal certainly favor a breakout here to the upside. Just be mindful of just the fact that even though we might be bullish, the upside may be fairly limited. So you have to be very selective in terms of what names you play, what sectors or subsectors you play. So hopefully this gives you some context around how I'm viewing that. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday, where I'm doing a special session on small futures with Jamal from Tastyworks. I hope that you'll be able to join us here talking about trading futures. I've been trading a lot of these products recently to gain some exposure to some, different things that have been moving in the market. So really looking forward to showing you some more of the products that they have launched recently. Thank you so much and have a great trading day.